When financial markets get volatile, how can you protect your portfolio without selling your stocks? In this video, we'll show you how protective puts can help you stay invested while managing your downside risk. So, what exactly is a protective put, also known as a married put? It's a strategy where you buy a put option on a stock you already own. Think of it like insurance. If the stock drops in value, the put can help limit your losses while still letting you stay invested. A protective put is sometimes called a married put because it's tied to a specific holding. Here's how it works. You'll spend a relatively small amount of money to buy a put option on a stock you already own. With the put in place, you've defined your maximum potential loss on that investment. You hope you won't need it, of course, but it can offer peace of mind, especially in volatile markets. And because the put has an expiry date, you'll need to renew your protection periodically, much like paying an insurance premium. You can also buy a put on a broad market index for general portfolio protection. While it won't match your holdings exactly, it can still help reduce downside risk when markets are turbulent. Let's look at a quick example. You own 100 shares of company ABC, currently trading at $50. You're happy holding ABC, but you're worried about market volatility, so you buy a put option that expires in 30 days with a strike price of $45. If ABC drops below $45 during that time, the put increases in value, helping to offset your losses. No matter how far the stock falls below $45, you've got a safety net. Now, there is a cost for this protection. You pay a premium for the put, which reduces your potential profit. And since the option has an expiry date, your protection is time limited. If you want to stay protected after it expires, you'll need to reestablish the put position. So when does this strategy make sense? Usually during uncertain markets or ahead of potentially market-moving events, like a company's earnings release. Some investors use protective puts when they're sitting on a nice unrealized gain and don't want to sell the stock and trigger a capital gain. A protective put won't eliminate all the risk, but it can help you feel more in control and less anxious when markets get rough. If you'd like to learn more about portfolio protection, check out our other videos on using options to manage risk, or visit our Learn site for a full article on protective puts. You'll find the link in the description box.